The risk of another global financial crisis has increased according to the International Monetary Fund. Daniel Ryntjes is following the spring meetings for the IMF World Bank meetings that are happening right here in Washington. And hello to you, Daniel. The previous reports say that the global economy is recovering, but now this is a little different.
Yes, Phil, just as we thought we'd shaken off the major impacts of the 2008 financial crisis, the IMF comes in and says there may be a new major risk on the horizon, but this time something that's complex, difficult to identify, difficult to deal with, and also spread across the entire global economy.
The authors of the IMF's biannual Global Financial Stability Report are concerned not only about an increase in global financial risks. These highly trained economists also admit that they don't themselves fully understand them.
Risks to the global financial system have increased since October and have rotated to parts of the system where they are harder to assess and harder to address.
Failures exposed in the European and American conventional banks following the 2008 financial collapse are being addressed by regulators who use stress tests and require banks to hold more capital. But now the IMF thinks many of the risks are shifting.
From banks to non-banks, from solvency to market liquidity risks, and from advanced economies to emerging markets.
There are concerns about what's broadly termed shadow banking, which basically refers to any non-bank financial institution engaged in bank-like tasks. They provide an example that mid-sized European life insurance companies are overexposed to potentially risky investments without enough cash to cover potential losses. But the IMF is also concerned that developing countries like Argentina, Brazil and Nigeria are more exposed to risk. Much of that is related to the recent steep decline in the price of oil and the rise in the dollar. They worry that there could be a drying up of liquidity, the inability to buy and sell assets and access cash in times of crisis.
So the range of potential risks they cite is definitely much more complicated. But the IMF, saying it's complex, has got a clear message to the international community, to companies and countries dealing with all of this. You must start to address these risks, identify these risks and deal with them. Phil.
All right. Daniel, the IMF, as we've talked about before, supports quantitative easing, but they also have warned about over-leveraging. I know we talked about this before. Explain that to our audience for us.
It's a little awkward. So the IMF is saying we need Europe and Japan to follow the US lead on this and introduce this quantitative easing. What does that mean? Essentially, it means once you've reached low interest rates, you have to find new tools to try to encourage people to borrow money because it's made cheaper for them. That is about encouraging people to take risks because there's an incentive to do so, to borrow money, to try new things. And that risk means that you also have to manage those risks. So in the context of Europe, potentially the banks are starting to deal with that risk. In some instances, the banks can't fully implement the borrowing into the consumer market because of previous bonds. But the problem is that there is this shadow banking system in Europe. The IMF has identified huge risks in the shadow banking system. And that is something that is a real worry that could spread a contagion across the global economy, as well as several others related to the dollar and related to these low oil prices. Back to you, Phil.
All right, Daniel, thank you very much. We're going to have more from you later on this week. Here's a look at